Hi, my name is Dion Putra, and this is our investment analysis comparing Diamond Pty Ltd versus Better Guys Pty Ltd. We'll help our client Valerina to decide which company she will invest 10,000 inheritance in. So, Valerina recently received an inheritance of $10,000 and is considering investing in one of two companies. So, the first one is Diamond Pty Ltd, which is an Australian jewelry business, and the second one is Better Guys Pty Ltd, which is a major electronic and appliance retailer in Australia and New Zealand. Uh, Diamond current share price between $1.10 and $1.30, while Better Guys has surged around $90 to $95. Uh, our job is to analyze and advise. So we move on to the third slide. So in terms of profitability, Diamond outperforms Better Guys in margins. Wait, which one is that? And it has higher gross profit margin and net profit margin, reflecting better cost control and stronger earning per sale. Better Guys, however, has a slightly better return on asset and competitive return on equity, showing efficient asset usage. Both companies are profitable, but their strengths differ. And for analysis, for the profitability analysis, both companies show overall strong profitability. Diamond delivers higher profit margins, while Better Guys stands out for its efficient use of assets. Also, Better Guys demonstrates more consistent growth over 2 years, giving it an edge in performance reliability. Sorry.
Good morning, everyone. My name is Arsal, and I'll be continuing the presentation from where Dion left off. I'll be covering the asset efficiency and the liquidity performance of both companies, which are Diamond Private Limited and Better Guys Private Limited, the two potential investment options for Valerina. Uh, this table compares several key asset turnover efficiency indicators between the two companies, from inventory turnover to the management of receivables and asset utilization. It's clear that Better Guys leads in operational efficiency. For example, their faster inventory turnover rate, which means they are selling and restocking inventory more frequently, which often reflects strong demand for forecasting and streamlined supply chain process. Additionally, Better Guys demonstrates higher total asset turnover, suggesting that they are generating more sales per dollar of assets. This points to a more productive use of their resources. While both companies manage their receivables well, Better Guy's ability to control inventory and utilize fixed and total assets efficiently and gives them a strong edge in the asset performance. This efficiency is crucial for retailers where tight margins require quick asset cycling to maintain profitability. Building on that comparison, we can conclude that Better Guys clearly leads in over total asset efficiency. Their superior turnover ratios that indicate they are more agile in operations and better at converting investments in assets into revenue. Faster asset turnover can also suggest that company is less likely to have capital tied up into non-productive resources. However, it's important to recognize that both companies should show sound receivables management. This tells us that their customers are paying on time and that both businesses exercise strong credit control policies. These qualities are important, especially in the times of economic uncertainty, as they support steady cash flow, reduce the risk of bad debts. So while the better guys excels overall, Diamond is not falling behind completely. It's just that a better guys operational model allows for more efficiency in utilizing its resources. Now, moving on to liquidity. Liquidity reflects a company's ability to meet its short term financial obligations, and it's measured by current ratio. Diamond's current ratio improved from 1.79 in 2023 to 1.84 in 2024. This improvement indicates that the company has slightly increased its cushion of current assets over current liabilities. Better Guys also shows an improvement from 1.32 to 1.38, which is a positive sign of growing financial stability. However, despite both companies improving, uh, Diamond maintains a significantly higher current ratio. This suggests that Diamond is in a stronger position to cover its short term obligations without the financial strain. A higher current ratio, especially above 1.5, can be reassuring for investors looking for a financial safety and liquidity resilience. To conclude this section, both businesses exhibit healthy liquidity levels, showing that neither is at risk of short-term insolvency. But when comparing the two, Diamond holds the upper hand in the terms of liquidity strength. It's stronger, and improving current ratio provides greater assurance to potential investors about its ability to manage liabilities as they come due. This could make diamond more attractive to risk investors who prioritize financial flexibility and protection in volatile markets. Nonetheless, better guys improving ratio shows that responsible financial management, and it's still within acceptable industry norms. And ultimately, while both companies are doing well in the managing liquidity, Diamond's more conservative and liquid balance sheet positions it's slightly ahead in this regard. And now I'll hand it over to Lois, who will guide us through the capital structure and final investment recommendations. Thank you.
My name is Lois Washeke, and I'm here to talk about the capital structure and the market share price context. We will begin with the capital structure, of which we as a group assessed the capital structure by comparing return on equity and return on asset. Diamond's wider gap suggests it's using more debt to fund its growth. And in contrast, Better Guy's smaller gap implies lower financial leverage and potentially lower financial risk. This makes Better Guys appear more stable and conservative financially. When we talk about the market share price context, Diamond's share price dropped from $1.5 to $1.1 and $1.30, which could represent a value opportunity if its fundamentals are strong. And Better Guy's share price jumped from $61.24 to over $90, which is showing a strong investor confidence. And in overall, Diamond might be undervalued while Better Guys is priced for ongoing growth. Thank you.
Hi, it's me, Krishala Pulami, and now I'm going to talk about the slide 11, which is investment suitability. Diamond offers high profit margins and a possible undervalued entry price. Better Guys is efficient, stable, and consistent, which is Ballerina's choice depends on her goals. If she prefers safety and growth, Better Guys is ideal. If she seeks strong returns and value investing, Diamond may be more suitable. Ultimately, it's a matter of risk return trade-off. So now let's go to the final part of this presentation, which is final recommendation. Our recommendation is Diamond Private Ltd. It offers higher margins, a strong liquidity position, and undervalued stock with growth potential. For an investor like Ballerina looking for growth with reasonable risks, Diamond presents a compelling opportunity. So, thank you.